Hello and welcome to TechnoFunda Investing, and in this video we are going to learn a special technique which is called special situation, through which you can actually invest in the stock market with much lesser volatility and sometimes significantly lower risk, as well as with much higher predictability if you are able to do it in a right way. Okay, so let's dive into it. And this video is sponsored by Smallcase. So thank you Smallcase for sponsoring this and educating retail investors so that they can understand all these situations. And let's straight away jump into this particular video. Hi, I'm Vivek Mashrani, and in this video we are going to learn about 5 different ways in which you can participate through special situation. Now, this video is going to be slightly technical, so make sure you take a lot of notes. I'll try to simplify as much as possible, but this topic in itself is slightly technical. Okay, so let's jump in. I'm Vivek Mashrani and I'm a TechnoFunda Investing specialist. I blend technicals and fundamentals for my investing research, and in last more than 14 years I've been investing. In last 2 years I've been helping more than 8,000 investors to go next level in their investing journey and make crores of rupees for their overall portfolio. So let's jump into this and let's understand the first point, which is called buyback. Okay, so the first way in which you can participate in these kind of special situation is buyback. Now there are 2 ways in which company buys back. So say for example, this is a company. Okay, they can buy back directly through market. Okay, so this is the market and they can directly buy shares from there. In this case, there is not much of advantage for retail investors as such, unless the demand goes up and the price also can tend to go up in the market. Now this is a special case where it is called tender offer route. Okay, so there basically company asks shareholders to tender their shares at a certain percentage at a certain price. So there is a price of buyback. Okay, so I'll tell this buyback price. Okay, and then there is another concept which is called quota. So there is a retail quota. Anyone who is holding less than 2 lakh worth of shares as on their record date, you are able to participate in the quota. And that is where it gets slightly more interesting, because as in quota, if there are a lot of FIIs and DIIs who are there in that particular company, and as a retail investor very few investors are there, you can get arbitrage opportunity also. Now let's say recently buyback came in of TCS, and I don't exactly remember the offer price, but say it was 3,800 rupees. And when this was announced, say it was 3,500 rupees. And say there is a 3 months time until the tender offer is getting triggered, right? So what will happen is, based on the tentative acceptance, the share price will slowly start going up. Of course, it will not immediately start going to 3,800 rupees because there is still time to this particular situation. Now, you might say it is a no-brainer, right? If we have 100 shares and you give it to company at 3,800, you make straight away 300 rupees profit on these shares. And the answer is 100% yes, it can very well happen. But there is a catch, okay, that based on the number of shares which are tendered, say company said that we want to have 100 shares to be bought back, and say 400 shares get tendered. Only 25% of shares will get accepted as a buyback and remaining will be given back to you. So what will happen is, here you might have like say 100 shares and you might only get 25% this 300 rupees profit. You might say, Vivek, it is still great because on remaining 75% shares we can sell it at same 3,500 price and we can make still a lot of profit. Here is another catch, because after you tender, there is a period of few days for which this entire process goes on. And say for example, after that process goes off, everyone wants to sell those shares, and this 3,500 can even go down to say 3,000 rupees. And this is where there is a possibility of incurring a loss if the acceptance is lower and the share price also significantly goes down. Now you might say, Vivek, then shall we not even participate in these kind of buyback scenarios? You can definitely. So there are two things to look out for. If the gap is significantly higher, say if it is buyback price is 4,000, your current price is 3,000, and based on whatever percent, say 5% they are taking back, the chances is say 50% of acceptance, then you know that your remaining 50%, the downside is at 2,000 rupees, which is very unlikely scenario. It can happen, but based on, these kind of scenarios, you can play around and you can size your bet. Okay. So this is how you can play buyback. And of course, it is not a risk free. Okay. There is always a risk, but it is a significantly lower risk if you understand the game and if you play it properly. The second thing is delisting. Okay. So delisting is where a company wants to delist its entity. Okay. So say for example, there is company A which is listed on BSE and NSE. Okay. If it is listed on both of these, now they want to go private. Okay. They want to delist from him. And say currently the price is 1,000 rupees, and they say, whoever wants to give your shares back to me, we are buying at 1,500 rupees. Okay. So there is a reverse book building offer that happens. There is a tentative price first, say 1,300 rupees, and then everyone tenders and they puts a bid, and then there is a price which gets fixed. Okay. So there is a price discovery that happens, and based on that, say at 1,500, whether company wants to, buy it or not, they can decide it. Okay. So a slightly complex process, but still, you have some price objectivity, and generally it is higher than the market price. So you can get still arbitrage in those situations. Okay. So this is like the second way. I told it is slightly going to be technical. I'll take some of the examples in the later cases so that you can understand. Now, next one is demerger. Okay, demerger is a very, very interesting space. So let's first understand what and why it gives you opportunity. Okay, so say for example, this is a company A. Now this company, this much portion is say pharma business. This much is say FMCG business, and this much is say hotel business. Okay. Now market doesn't like these kind of unrelated business, because pharma can be highly profitable business, which is pumping money into hotel unnecessarily. Okay. So it gets something called as holding company discount, because they are holding unrelated businesses and the capital allocation is not efficient. Now say for example, this company decides to demerge all these three business, A, B and C of hotel. What will happen is somebody who wants to buy pharma business, they will buy this and they will give a proper valuation to it. Somebody who wants to buy FMCG, they will give proper valuation to it. Somebody who wants to buy hotel, they will give proper valuation. So in total, this might have 1,000 rupees value, but this can become 1,200 rupees value also. Okay. Now you might think, Vivek, but then it's a great idea. This is a risk-free arbitrage. Here also there is a risk, because when you are participating, the price might be 1,000 rupees. For some time, the listing might not happen. And after say 3 months, the listing happens. And after 3 months, the market is not in great mood, or you go into a bear market. This 1,200 can also become 900. Because that same 1,000 rupees might have been quoting that time at 700 rupees. Okay. So that way, sometimes there is risk in demerger also, but at least, if you are holding that company and you really like, certain businesses, you can still participate and keep holding it. Okay. So that is one way to look at it. Another way to look at it is, say for example, there is a business, same example, say pharma, and you have say hotel. Okay. And this is like a 90% of the business. This is 10% of the business, and say 2,000 crore is the valuation of the company. Okay. Now this business gets demerged, pharma A. So I'll tell it A pharma, and B is hotel. Okay. Now this, say for example, gets 1,900 crore valuation, and this gets say 200 crores valuation, right? Although value unlocking has happened from 2,000 crore, it has become 2,100 crore. What will happen is, say a mutual fund is holding this particular company under mid cap category. Now they get these both businesses. Now, based on mutual fund guidelines, they might not be able to hold this 200 crore company, even though it might be a great company, just because of the mandate of the mutual fund. So they need to compulsorily sell this business. So sometimes you might get opportunity where these businesses can be available at a significant discount just because a fund is forcefully selling it. Okay, so this is like another way to do it. So this is on demerger. Now let's understand merger situation. Okay, merger, how you can make money. So say I'll give you a practical example which happened a couple of years back, is of Suprajit Engineering. Okay, and you had Phoenix Lamp. Okay, both were listed company, and these kind of situation generally comes when both the sides are listed. Okay, so we had Phoenix Lamps. Okay, now say hypothetically, again I don't remember the exact prices and everything, but say hypothetically Suprajit was trading at 200 rupees and Phoenix Lamp was trading at 1880 rupees. Okay, I'll just write it below. So 80 rupees was Phoenix Lamp and Suprajit was 200 rupees. Now Suprajit announces a merger ratio, and it tells for every 2 shares of Phoenix Lamp, you will get 1 share of Suprajit Engineering whenever this merger happens, right? So in essence, even you can buy this from market. Okay, so 80 rupees you can buy 2 share, it will cost you 160 rupees and you get 200 rupees. And you might say, Vivek, then this is a great opportunity because we can like pocket this 40 rupees very, very quickly. Now market is smart again, right? So one thing might happen is that 80 rupees will come closer to 200 rupees. So say 90 rupees and then 90 into 2 will become 180. And still there will be some spread which will be remaining most of the times, is because uncertainty of that merger. It can happen that merger fail, and this entire thesis can go for toss, and even if you have bought Phoenix Lamp, you don't get Suprajit Engineering, right? So there are a lot of regulatory uncertainties and this merger can be called off. That is the reason sometimes even if everyone knows that this situation is going on, you still have some spread remaining. So it's partly arbitrage, partly a risk factor which is being priced by the market. Now where it gets interesting is you are fine to hold Phoenix Lamps even if the merger doesn't happen, and you are fine to hold both these companies in total also. Or you want to ultimately buy Suprajit, but even if this doesn't happen, you are fine to hold a Phoenix Lamp share. Okay, so in those situations you can get really a cheap arbitrage if you really want to play it around, and if you use some of the exit strategy, that can even be better. Okay, so you can use a lot of risk management techniques and go deeper into it. Like I've covered a lot of these risk management techniques in my book, which is You Can Compound. It's a #1 bestseller on Amazon. You can check it out. I'll place the link below this video. I've shared a lot of these strategies, deep dive, where you can understand how properly you can exit in these kind of situation and how to benefit from this. Okay. Now I want to share a special thing before we jump in next, is through our sponsors, right? So Small Case is the sponsor of this video, and this is an amazing platform where you can invest into direct stocks through different small cases from different advisors. You can link it with your broker and you can just get started. So there are so many small case you can explore. There is also a special situation small case, and one of the small case which we also had a session with is of Niveshai. Okay, so I'll just pull out the picture. If you remember, we did a session on our YouTube itself. It's called on Scuttlebutt Investing. You can even check this out. Okay, it is a 47% CAGR small case for last 3 years. Very interesting strategy that they are running. And if you want to participate in this, I'll just give you a special link in the description also. It's called technofunda.co/Niveshai. So you can just check it out and understand what they are doing and how are these methodology of small and mid cap investing through which they are getting these kind of phenomenal returns. Okay, so let's now jump to the fourth situation where I'll tell you how you can make money through a situation called change in management. Okay, and before we even jump in, I'll give you a potential of this. Okay, let me share the screen. And what is the kind of potential if you are able to do it correctly? So this is a case study of CG Power. This was a 5 rupee stock on 1st of April 2020. And as we record this video, this is like a 200 rupee stock. Okay. So it is a 40x. So if you would have put in 1 lakh rupees, it would have become 40 lakh rupees. Okay. This is the potential of special situation if you do it correctly. Okay. Again, the idea is to do it correctly. Now, what is this change in management special situation? Let me explain you. Okay. So say for example, there is a company A, which is probably having, bad corporate governance, or they might have bad capital allocation. They are not putting money properly, or the promoter is chore. He is pulling out money and siphoning money. Now this company, because of all these, bad things that is happening, although the worth of this company might be very good, or sometimes, even because of debt they have taken, or they are in distress situation and this management is not able to handle properly, this company's valuation can come down significantly. Okay, even sometimes much lesser than their fair value. Now say for example, this is a promoter 1, a promoter 2, which is a great management with good track record, good trust in the market. They acquire this company from the first one. Okay, so sometimes if there is debt, they might repair the debt. Sometimes the old promoter is doing siphoning. These promoters will not do. They will also efficiently put up the capital. They will disclose all the things properly, and the corporate governance can come up. Okay, so this way, what will happen is share price will go to the fair value, or sometimes even more than fair value, and the multiple of that company, the PE multiple, also will get re-rated. Okay, so this case which I showed you was a case of CG Power. Okay, so CG Power, what happened is a Murugappa Group company acquired this. Okay, let me just close this. So a Murugappa Group company acquired this from a promoter which was not able to handle the debt situation, and a lot of issues were there. So because of just change in perception and the re-rating, this business went to the roof. Okay, so this kind of special situation also you can play, which is change in management. And finally, the fifth one is open offer during acquisition. Okay, so let me give you an example around it. What does it mean? Let's go to the picture first. So say for example, there is a business, say there is a live situation which happened some time back. I'll tell you about it. It's Esselia. Okay, it is company called as Esselia Solutions, for which the same situation happened some time back, so that you can understand. As an example, I'm giving you this. So say Esselia was having 75% promoter holding, say of promoter 1. And then another company acquired this, and in fact there was a holding company here, okay, which was holding this 75%. They acquired this entire holding company, and because of which this 75% came to the guy 2, okay, and remaining 25% is being holded by public shareholders. Okay, now what happens is, say for example, the price of Esselia, if I remember correctly, was say around 900 rupees that time, and say the price of acquisition was say 950 rupees. Now, when this change of promoter happens from 1 to 2, you have bought the share thinking that promoter 1 will run this company. And now, you have a surprise that, okay, now promoter 2 is running. You don't know whether this guy will run correctly or not. You don't probably trust them, or you want a choice to exit this company. So that's why SEBI has given a clause of open offer, that when there is a significant change in the control, if the management itself is changing and the control of the company is changing, this 25% shareholder should get a chance to exit. And they should get a chance at least minimum to the price which 2 has offered to 1. Okay, so if they bought for 950 rupees, at least minimum price should be 90, and there are other clauses through which the price discovery happens. It can even go more than 950, even 1000, 1200 and all those things. So there you get again an opportunity that if you have that market price at 900, you can tender it at 950, just because the company has mandatorily put an offer, and sometimes the share price will also significantly re-rate very fast to factor in that entire thing. But still there will be small gap many times to just adjust the risk of a failure and some regulatory reasons. Okay, so this is how the situation of open offer exists. And I'll just show you the example of Acelia, which I told you. So I'll share the link also in the description. You can check it out. So this company had a, open offer at 944 rupees. And, those who tendered their shares, they basically got 950 rupees per share for that particular company. Okay. Now there is a website where you can find out a lot of these special situations that is going live. It is run by a community, and you can check this out also. I'll just share the link of this if you want to check it out. It's a free service as of now. I don't know in future if it will be paid or not. But as of now, if you want to check it out, you can go to technofunda.co/special, and you can see like you have dates of when this entire special situation is going to complete, what is the current stage, what is the next stage, and what is exactly the situation, which is the company, and all those things, right? So this is a brilliant source. You can go and check it out and use it to your advantage based on whatever I have shared in this video. Okay, hope this video was useful. Don't forget to like this video, and if you are not following me on Twitter, just go and check it out. I'm also on Twitter sharing a lot of learnings on investing. Thank you so much again. Take care and have a remaining amazing good day.